Good morning, everyone, and welcome to the Daily Hunt for Multibaggers. It's Saturday, April 25th, 2026, and we're here to distill all the market chatter and AI-generated insights from yesterday, April 24th.
That's right, Ethan. Today, our AI scanned a significant number of discussions, flagging numerous stocks. What we're seeing is a fascinating blend of fervent optimism driving some assets, alongside some very sharp data-driven caution for others. It's certainly not a one-way street out there.
Absolutely. Let's dive right into some of these. First up, we've got Destiny Tech 100 Inc., DXYZ. Now, the community is buzzing about DXYZ, pointing to a strongly bullish sentiment. There's a compelling argument that its actual net asset value, or NAV, is significantly higher than what's officially reported, thanks to the recent sky-high valuations of its private holdings like Anthropic and SpaceX. They're saying it's undervalued right now, trading closer to its 52-week low. That sounds like growth potential to me, you know?
Well, Ethan, while that bullish narrative about underlying assets is certainly exciting, we have to remember DXYZ is a fund investing in private companies. Those NAV estimates are just that, estimates. They're less transparent and can be quite illiquid, and traditional profitability metrics like PE are almost irrelevant here, as it's not generating operational profit in the usual sense. The value is tied to valuations that aren't publicly traded, which introduces a different layer of risk. My read is to buy it, but with clear awareness of those unique risks.
Fair point on the estimates, Brooke, but the potential, for those private valuations to convert into significant gains is what gets people excited. Moving on, let's talk about Palantir, PLTR. There's a very strong conviction out there, with some users boldly predicting it'll hit $1 trillion market cap within 5 years, backing that belief with aggressive investments. We've also seen positive news on major contracts, like the USDA deal.
Ethan, that kind of conviction is certainly a strong sentiment signal. But when you look at the KPIs, Palantir's valuation metrics are extremely stretched. We're talking a PE of over 223, a PEG ratio above 3, and a high debt-to-equity ratio. These numbers suggest that an incredible amount of future growth is already priced in. And don't forget, we've seen insider selling over the past 6 months, which is a signal of caution from those closest to the company. My analysis indicates stay away for now.
Okay, shifting gears a bit. AMC Entertainment Holdings, AMC. Now, looking at our data, there's a really interesting point here. Significant insider purchases recently, with over 4.7 million shares bought in the last 6 months and 0 sales. That's a huge vote of confidence from within, suggesting they see value at current levels.
That insider buying is a positive signal, Ethan, but we can't ignore the severe fundamental weaknesses that have consistently plagued AMC. We're seeing negative net profit margins, negative EPS, and even a negative price-to-book ratio, which suggests liabilities exceeding assets. The stock has been in a consistent downtrend, and discussions still characterize it as a degenerate play from past losses. For most investors, the current KPIs make this a stay away. The insider buying, while interesting, just isn't enough to counteract the significant financial distress.
All right, let's talk Micron Technology, MU. The semiconductor sector is on fire, and Micron is right in the thick of it. Users are describing it as a solid, hyped company with excellent results, hitting all-time highs. We're seeing an exceptionally low PEG ratio of 0.28, robust revenue growth, and strong net profit margins. The news is also pointing to a memory supercycle driven by AI. It's hard not to be optimistic there, Brooke.
It's true, Ethan. Micron's performance has been impressive, and those growth and profitability metrics are compelling. The AI tailwind is a powerful catalyst. However, we do note a relatively high debt-to-equity ratio, and in one analysis, some insider selling, though the percentage is small. The price is also very near its 52-week high, meaning less immediate upside if you're a new investor looking for a bargain. But overall, the fundamentals are strong, and the market narrative is powerful. So for Micron, I agree. Buy.
From one chip maker to another related company, SanDisk, SNDK. This one has seen a massive surge, with users highlighting that betting against the semiconductor momentum has been suicide. The stock has made an extraordinary climb from its 52-week low.
Ethan, while the momentum is undeniable and the historical price surge is impressive, SanDisk presents a stark contrast between market sentiment and fundamental health. It's trading near its 52-week high with an extremely high price-to-book ratio of over 14. But here's the kicker. It has a negative net profit margin and negative EPS. A company stock soaring to such heights while it's fundamentally unprofitable is a significant red flag. This looks like a speculative rally, so my verdict is stay away.
Moving on to Figma, Fig. This company has a strong product, considered indispensable by many, with high penetration among S&P 500 companies. The stock is currently trading near its 52-week low, which some users see as an attractive buying point. Plus, there's been substantial insider buying, indicating internal confidence.
I appreciate the product loyalty, Ethan, but the KPIs tell a cautious story. Figma has seen a massive 88% drop from its 52-week high, and its profitability metrics are consistently negative. Negative net profit margin, EPS, ROE, ROA, you name it. Despite its revenue growth, it's still losing money, and its PB and PEG ratios remain high for an unprofitable company. There are also significant concerns about AI competition. That dramatic price decline is likely rooted in these issues. This one is a stay away for me.
Next, let's consider Adobe, ADBE. This stock often brings out strong opinions. Some users are applying the be greedy when others are fearful mantra, noting a relatively low PE and PEG ratio for a tech giant. Plus, there's a substantial $25 billion buyback plan and insider buying, signaling management confidence.
That's one perspective, Ethan, but the overwhelming sentiment in discussions is quite bearish. Users are expressing deep concerns about Adobe's vulnerability to AI, the perceived lackluster nature of its own AI tools, and a feeling that the company is alienating its loyal user base. The stock is significantly down from its 52-week high, and while the buyback and insider buying are positive corporate signals, they don't fully address the fundamental challenges users are pointing to. The risk of future revenue erosion due to competition is too high. I'm calling this a stay away.
All right, let's talk Amazon, AMZN. Users are making some high-conviction bullish bets, even YOLOing at what they perceive as the top. There's strong institutional support from firms like Truist and big names like Bill Ackman. Amazon's expanding into exciting areas like AI chips and healthcare, showing robust revenue growth and healthy profit margins. Plus, we've seen insider buying. It's true, Amazon is a behemoth with strong growth engines. The revenue growth and profit margins are impressive. However, it's currently trading right at its 52-week high, and its PE ratio is quite high at over 36, indicating steep expectations are already baked into the price. While the strategic moves into AI and healthcare are promising, and insider buying is a good sign, the immediate upside might be limited due to the current valuation and high volatility expected around its upcoming Q1 earnings. For those with a long-term view, it's a buy, but caution is certainly warranted at these levels.
Now on to Nebius Group, NBIS. There's a lot of AI infra hype around this one, with users believing demand for AI compute will just keep exploding. The stock has seen a massive surge, over 500% from its 52-week low, and they've secured huge contracts, like the $48 billion deal with Meta.
Ethan, the hype is certainly there, and the revenue growth is strong, but the KPIs are flashing some very serious red lights. We're looking at an extraordinarily high PE ratio of over 1471, and crucially, a negative operating margin. This means NBIS is losing money on its core operations, despite the massive demand. Add to that a very high debt-to-equity ratio and insider selling, and you have a recipe for significant financial risk. The consensus in some discussions is that the easy money has been made. This is definitely a stay away for me.
From one tech giant to another, Microsoft, MSFT. This company is consistently seen as a stable, long-term play with immense growth drivers in AI infrastructure, cybersecurity, and cloud. Excellent revenue growth, phenomenal net profit margins, and a strong return on equity really stand out. Even Jim Cramer is positive on it.
Microsoft's fundamentals are indeed rock solid, Ethan, and its strategic positioning is excellent. However, with an upcoming earnings report, there's always short-term caution. Its PE ratio, while reasonable for a growth tech stock, means that high expectations are already priced in. Any disappointment, even minor, could lead to a correction, as some users are worried about a post-earnings drop. But weighing everything, the long-term strength is undeniable. This is a clear buy.
Last but not least, IREN Limited, IRAN. This company has made a major AI cloud pivot that's exploding and causing significant stock jumps. High revenue growth is a testament to that strategic shift.
The AI pivot is certainly a strong narrative, Ethan, but IREN is also a very high-risk play. Its PE ratio is high at over 35, and its PEG ratio is above 3, indicating potential overvaluation relative to its earnings growth. More concerning, it has a negative operating margin, meaning its core business is losing money, paired with a very high debt-to-equity ratio and an extremely high beta, suggesting extreme volatility. Analysts are cautious with hold ratings and lowered price targets. The KPIs indicate this is a stay away.
So, Brooke, wrapping up our analysis for the day, here are our compiled candidates for deeper analysis. Investigate as buy.
Destiny Tech 100 Inc., DXYZ, Micron Technology Inc., MU, Microsoft Corporation, MSFT. Investigate as cautious by Amazon.com Inc., AMZN. Investigate as speculative gamble, Palantir Technologies Inc., PLTR.
And that brings us to the end of today's episode.
Remember, this podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice.
Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred.
The market is a wild place, and knowledge is your best asset. Thanks for tuning in to the Daily Hunt for Multibaggers. We'll catch you next time.